Investing in the stock market can be overwhelming. There are so many indicators and so much to learn. What if I told you we could use a simple set of rules to make the whole process a lot easier? Hi, my name's Peyton, and on this channel, we talk about personal finance, investing in the stock market, and a lot of stuff that they just don't teach us in life. So, if that sounds like something you're interested in learning about, simply subscribe below, check that bell icon so you're notified whenever we release new videos, and stay tuned for more. So, investing is a great idea, but before we start just throwing money at the stock market, let's get a better idea of why we're doing it and ways we can avoid trouble. So I've left timestamps down in the description below, so feel free to jump to the section that really interests you. And at the very end of this video, I'll give you my exact set of rules that I use for my own investing. Okay? So first thing that we need to do is we need to figure out, why are we even investing? So are we wanting to try it out? Do we want to make money? Do we want to save for the future? Or is it some kind of combination of all this? By knowing why we're investing, we can actually get a better idea of the rules that we need to build for ourselves. Okay? So the next thing is, once we've figured out the why, let's figure out our strategy. So are we going to simply just use dollar cost averaging, which means we're going to take a certain set of money each month, we're going to simply invest that amount, and over time, the actual cost of the stock is going to average out. So that means if one time the cost of the stock is $100, the next time it's $300, it's going to start averaging out. Will be somewhere around maybe the 200, 225 mark. Okay, so we're not worrying about the ups and downs of the market so much, just that we're getting our money into the market. Okay, the next one is dividend investment. So this is the one that I actually use, and basically I'm going to choose stocks that pay me back a portion of my money on a consistent basis, which then I can then use to reinvest back into that stock. So for me, that works. You can also be doing swing trading or day trading. So if you have a lot of time to invest in this and a good chunk of money to get started, you can actually start doing swing trading, where you're looking for changes in the market and investing and trying to take advantage of that, or doing day trading, where you're making constant trades throughout the day to catch those ups and downs in the market and make the most money. And then other things too, are you looking to do an options trading? Do you want to trade on whether or not the stock's going to go up or down? And kind of work on that. You can make a lot of money there, but you're also risking a lot of money too. And of course, you need to make sure to take the time to do that. Okay, and then finally, how technical do you want to get? Do you really want to figure out what kind of cash influx a company has? How are they compared to their competitors? What do their individual stats look like at a nitty-gritty detail? So again, this takes a lot of time to do. It's really great to do that, but you got to make sure you have the time. So once you figured out that investment strategy, the next thing is really understanding the impacts of the strategy you've chosen. So for example, if you're doing dividend investing, there are tax implications with that. So if you're in, say, an IRA versus a normal brokerage account, there's also tax implications with that too. So you want to know, for the amount of money that you're making, how are you paying taxes on that? You're not really going to be able to get past that. At some point, you do have to pay those taxes. Just know how it impacts you at that moment. Okay? Also understand how much time it takes for your strategy. If you're doing dollar cost averaging, you're really just kind of picking out your stocks and then buying them when you have that money. But if you're doing swing trading or day trading or even technical analysis, you're going to have to spend a lot more time really going through those stocks and understanding them. Okay? Another thing too is, are there account minimums for the type of trading that you want to do? So for example, if you want to do day trading, there's a certain portion of money that you have to have in your account to do that. And you also have to do it on margin, which means you're borrowing money to make those trades and then paying that off. Okay? So there are certain implications of each of those strategies. Okay, so now that we know our why, our strategy, and the implications of that strategy, we can finally move on to the actual rules themselves. Okay, so I'm going to do this from the idea of dividend investment, because that's how I built my own rules for my own strategy. You can take these same kind of rules and apply them to your own strategy, but you might need to tweak it a little bit. Okay, so for me in dividend investment, I wanted to figure out whether or not I want to invest in short terms and then try to sell that and try to make a profit, or if I'm going to try to be in that stock for a long time. So if I'm trying to get into a stock, let's say I buy Tesla, which is usually outside my budget. If I go ahead and buy Tesla today and then it jumps $20, do I go ahead and sell it now, or do I hang on to it for a long time? Same thing too, if I buy into it and it goes down, how long am I waiting for that stock to be at a lower price? Okay, so you have to kind of figure out how long you want to be in. Again, there's tax implications with this too. If you're holding onto a stock for a short amount of time and then you sell it for a profit, there's a higher tax rate you're going to get charged for that versus if you hold it for, say, a 2 or 3 year period and then sell it for a profit. Okay, so you have to remember back, depending on your strategy and what kind of account you got, there's different implications still with your rules. So for me, I've chosen to actually be in for the long haul. Okay, so I want to try to avoid those tax implications of selling quickly. And I want to avoid any kind of make money quick schemes that might come with picking and choosing stocks, because more than likely, I'm not going to be reacting fast enough, or I might miss it because I don't have necessarily the time to constantly watch it. So I'm going to only buy stocks that I want for the long haul. Okay, so I'm looking for 2 to 3 years, probably even more, something that can sit there and constantly grow over time. Okay, now because I'm also using dividend investment, the next thing that I want to think about too is the type of companies that I'm going to invest in. I want dividends back, but how do I figure out what stocks to actually use for dividends? Okay, so one thing I'm going to do is I want to find companies that are actually going to pay their dividend consistently. So I don't want to go a couple years without receiving a dividend and have, say, $1,000 invested in this company that's not paying me, when that $1,000 could be somewhere else making me money. Okay, so the way that I go about that is I use the Dividend Champions list and Simply Safe Dividends. By using those, I can figure out companies that not only pay the dividend in the range I want, but they're actually going to consistently pay me those dividends. Okay, now speaking of the percentage of the dividend that I'm receiving, or the dividend yield as it's called, I'm looking for dividends that pay at least 4%. Okay, I'm looking for higher dividends to get more benefit from my money. Now, you can also choose stocks that are on a lower dividend, but for me, I want to try to make a higher percentage of my money back. So that's why I'm going for things that are at least 4% or higher. Okay, now the next thing we want to think about too is, just because the dividend yield is high, that's probably not going to be the only thing that we want to think about. If something has, like, say, a 40% dividend, there's probably a reason why it's so high, and that's just not normal. So the dividends or the dividend yields we're kind of looking at are probably going to be like maybe a 4 to 13%. Stuff that starts getting past that, I don't know. To me, it seems a little bit fishy. So think about what you're comfortable with and build a rule about the actual dividend yield. Are you comfortable with a 2%? Do you want a 4%? Or do you want to kind of risk it and hopefully maybe get one of those 40% yields if they're actually legit? Okay. The next thing we want to think about too is that the performance of the stock that we're thinking about actually getting. So they always say past performance is not a future indicator, but to me, it actually helps a lot. So if we look at a stock's chart, okay, and I don't have one here for us to look at, but a lot of stocks, if you look at them at, say, the daily or monthly view, you might kind of see this number. It goes up and down, up and down, up and down. But if you look at a longer term picture, a yearly chart, you're going to maybe see it going up, or maybe it's actually just going down over time. That gives you a real good indication of where it's going to continue to go. Now, I'm not saying that if it looks like it's going up on the yearly, it's always going to continue to go up, but it's a good indicator of where it might be going, okay? So now different things can affect that. So let's say that we have somebody that does, I don't know, like old school telegram services using Morse code, and for some reason they have had a stock that's constantly going up. It's probably not going to stay that way, okay? But if you've got something like, let's say, a car company like Ford or Tesla or somebody else, and their stock on the most part is going up, and they still have kind of those daily dips and spikes, then more than likely they're going to continue going up, okay? So we're looking at for kind of the average of where that stock is going. Another thing that we're going to look at too is we're going to try to see how the stock actually reacts during certain things, okay? So during dividend payments, if you're looking on Webull, there's a little D icon with a circle, and whenever those items pop up, does the stock suddenly plummet afterwards? Is there a rise in the actual price of the stock coming up to the dividend? And then where are we at right now? So maybe it's not necessarily a great idea to buy in at this moment, but do we maybe wait for the next dividend to pay out, knowing that the stock's going to go down and we can buy in at a low spot? we're kind of looking for where that average line is throughout the stock. Okay, now if you're doing dollar cost averaging, that doesn't matter so much. Or if you're doing small individual buys, it might not matter as much. But it gives you a good picture of where you're going. Okay, so you're kind of looking for that average position of where we're at, knowing that that plays in. And so you can kind of think about creating rules based on that. Do you say, hey, I'm only going to buy in after the stock drops after a dividend? Or am I just going to buy in when I can? Okay. The next thing too is that we want to start creating rules about how we're going to split our money up. So we don't want to just simply buy, say, all of our money goes straight to Tesla and nowhere else. Okay. So we want to think about diversifying our funds. So we're going to create rules based on the different sectors that we want to invest in. Okay. So try to think about things that you're interested in, things that you can kind of look up, or things that you're familiar with. So for example, for me, technology is a big one. I use it in my job. I use it constantly on a daily basis. So I'm familiar with companies like Facebook and Google and other services like that. I'm interested in vehicles, so I can keep up with things like Ford and Tesla and NIO and get to better understand those and really know what's going on in those individual sectors. And then I'm also going to be thinking about sectors that maybe I don't know a whole lot about, but I know they're going to be stable and around for a long time. So the energy sector, real estate, people are always going to need houses and electricity to power those. So I started thinking about the sectors that I want to invest my funds in. Okay. Another thing too is think not only about local companies within the country that you're in, but also in other countries. There are also certain funds that you can purchase that allow you to easily invest in foreign markets without having to pick and choose individual stocks. So you can buy a fund that tracks those other sectors in other countries. Okay. Another thing too is we want to start thinking about risk. So we need to define what kind of risk that we're comfortable with for ourselves. So are we comfortable with risking 50% of our portfolio in a random stock that if it plummets, we've now lost 50% of our money? Or do we want to be a little bit safer and risk only a certain portion of our funds so that we can actually safely kind of test out ideas and theories and maybe earn a little bit of money without losing everything? Okay, so we want to start thinking about that and define some kind of number. Is it a 10% of our portfolio? Maybe a 5%? Okay. And then the next thing too is we want to also think about index funds. So I know it sounds boring. What is an index fund? It's not as fun as picking stocks. But basically what an index fund is it's a collection of stocks. You just buy into one item, which is the fund itself, and that money kind of gets split up between the individual stocks that make up that fund behind the scenes. Okay. The reason why we want to think about doing that is we're going to be picking and choosing individual stocks, but more than likely, we're not going to actually beat the overall market's performance. Okay. We'll have our ups and our downs, but unless we're just really lucky, we're not going to be reaching higher than the index. Now, if you've created your portfolio and it's diversified enough, you might have kind of built your own index fund, which tracks the progress of the funds within your portfolio. But at this stage, if we're just starting out, let's safely invest some of our funds into an index fund. That way we know that even if a lot of our stocks are dropping, we've still got something that's steadily going up, even if it's at a lower rate than what we want. We've got something that's kind of boosting our overall portfolio. Okay, so let's kind of think about that. Okay, great. So now that we've kind of go over the things that we've wanted, go ahead and make a list of those items. Start kind of writing down what you think your rule set might look like. For me, I've got 8 rules. Let's talk about them. Okay, so my 8 rules is number 1, I'm only going to buy stocks that I want for the long run. I'm going to hold on to them. I'm going to make sure that I keep them as long as is necessary to reduce my tax burden. And I'm going to be understanding that when I'm looking at stocks to buy, they need to last for at least that time amount. Okay, so now item number 2 is I'm only going to invest in companies that pay at least a 4% dividend consistently. I want enough of a dividend coming back, and I want to have it as when I'm supposed to have it. I don't want to be waiting around to see if it's going to actually occur for the next 3 years that I have that stock at least. Okay, so number 3, if a stock performance is too inconsistent, then I'm not going to use it as a core or primary stock. Okay, so if that stock is going up and down, I don't want to invest a ton of my money there. I might still invest a small portion of it, but I don't want a massive percentage of my portfolio to be in that really inconsistent stock. Okay. Rule number 4, I'm going to diversify by choosing stocks from different sectors. I'm going to split it up between energy, vehicles, technology, etc. Okay. That way, all my eggs aren't in one basket. Okay. Rule number 5, I'm going to invest in some index funds. I haven't chosen a percentage for myself on this, but I will be choosing something like a Vanguard or something else that has a low percentage. And some of those index funds will be local to the US and some will be overseas. Okay. Rule number 6, I'm only going to use 5% of my overall account balance for risky stocks or testing ideas. Okay. Rule number 7 is small gains by trying to time the entry into the market can hurt me. So instead of, so I'm going to just buy the stock instead of trying to save 10 cents here and there by waiting for things to go up and down. If I time that incorrectly, it can really hurt me, and I might end up spending $2 or $3 more than what I originally wanted to by trying to save 10 cents. Okay. And then rule number 8, and this is one that I struggle with a lot, is don't watch the stocks constantly. Okay. I'm not a day trader. I'm not looking to sell things or buy things constantly. I simply put money into my account during my paychecks, and I have that money available to buy the stocks. So when it's time to buy, I'll go ahead and buy it. And then maybe once a month or something like that, I might take a lot of time and kind of go through what kind of dividends have I paid out? Are things consistent? Where are things at? But it's just too stressful to constantly watch your stocks all the time, knowing that you're still going to keep them for 3 years. So try not to be worried about the constant up and downs that go on the day. Think more long term. What does that yearly chart look like for you? Are your stocks always going up? Or are they always going down? So kind of think about that. Okay. So, all right. So to kind of wrap up our conversation today. So these rules, they're really just a starting point. Even for me, I'm going to be checking in on these every quarter and seeing how they've worked for me and whether or not I need to change them. Another thing too is it's really important to remind yourself of what's important to you. Think back to why you're doing this. Think back to your overall strategy. So the small nitty-gritty needs to support that strategy. If not, then we might need to change some of these rules or really kind of rethink them. Okay, and another thing too is we need to know the stock market is constantly changing. There's so much stuff going on out there. Each of these stocks are backed by a company that's making its own decisions. So things will go up, things will go down, but staying true to why we're doing this is what's really important. Okay, guys, I really hope this helped you out. Like I said, if this is the kind of material you want to see, let me know down in the comments below, and I'll try my best to help create more of these beginner-friendly videos. I myself am still a beginner, still learning this, and so I want to share my journey with you as I go through this. One of the next things I'm going to be doing is I'm going to be releasing a video pretty soon on how to use these rules to actually invest your first $100. I know it doesn't sound like a lot, but the rules and the way that you invest that first 100 will help you with your second 100, your second 1,000, whatever that amount is. I want to let everybody know that you don't have to have a massive amount of money to invest. You can start slow and build it over time. So I'll show you guys kind of what my actual account looks like, how I invest my money. And typically for me, sometimes I really am just investing $100 each paycheck. Sometimes I might invest a little bit more if I get a little extra side money or something like that. But for the most part, I'm investing small amounts. So guys, I hope this really helped you out. Take a look at the videos in the channel, and I look forward to seeing you guys in the next video. Have a good one. See ya.